We are looking at a highly detailed set of financial results for a very specific entity. It's called Digital Core REIT, traded under the ticker DCRU.
And just for context, we're looking at their first half of 2026 results.
Right, which were just released on July 29th, 2026. And we also have their updated slide deck from August 2026. So if you follow specialized real estate, you know that data centers are basically the absolute frontier right now.
Oh, without a doubt. This deep dive is prepared purely for educational and entertainment purposes.
Right.
It is a synthesis and analysis based on publicly available information. It absolutely does not constitute financial advice, an investment recommendation, or, an offer or solicitation to deal in any securities whatsoever.
We are just here to unpack the sources.
Exactly. The views we discuss are based on sources believed to be reliable, but they haven't been independently verified. Past performance is never indicative of future results. So always conduct your own rigorous due diligence and consult a licensed financial advisor before making any investment decision.
Perfect. So setting the stage here, we're looking at a real estate investment trust, a REIT, that operates in a very unique space.
Right. When you look at their foundation, they own a highly scarce asset base of 11 data centers.
It's
just 11.
Yeah.
But these are massive, highly critical assets. And this isn't geographically concentrated in one single market either.
Yeah.
They have a spread across the United States, Canada, Germany, and Japan.
Okay, let's talk about the specific nature of those assets, because there's one word in their portfolio description that completely changes the financial calculus.
Oh, absolutely.
It's the difference between renting a hotel room and owning the actual hotel. These 11 data centers are freehold assets.
It comes down to the structural bottlenecks of the modern digital economy. When you look at the metropolitan areas where these data centers are located, places like Northern Virginia, Frankfurt, Los Angeles, it isn't the availability of land that is capping the supply of new data centers.
Right. You can always find an empty lot somewhere.
Exactly. You can find land. The true bottleneck is the availability of power.
The grid.
Yes. The local utility grid simply cannot support the massive gigawatt-level energy demands required to power and cool thousands of humming servers.
The logical next step is to examine how effectively they are monetizing them.
We have to look at the money.
Right.
And according to their first half 2026 results, the DPU for the trailing 12 months ending June 30th, 2026 was 3.60 US cents.
3.6 cents. Now, 3.6 cents might not sound like much in isolation, but we have to look at the trend line.
And that's where it gets interesting.
Because the results point out that while this recent trend is relatively flat, if we zoom out to the broader arc, the trajectory is actually negative.
Yeah, unfortunately.
If you look back at their financial year 2022, the DPU was higher. It was sitting at 3.98 US cents. So we're looking at a negative compound annual growth rate, a negative CAGR of 3.3% from FY 2022 through FY 2025.
Right. So the actual cash payout has been slowly compressing over the last few years.
But we have to translate that distribution into a yield to see what investors are actually earning on their capital. A 7.19% yield is quite attractive.
It's a very solid yield on paper.
But we need to look beneath the yield of the units and look at the yield of the actual concrete and steel. The results give us the aggregated property yield for the entire portfolio, which currently sits at 4.94%.
And context is key there. A 4.94% property yield is widely considered to be in a very decent normal band for the data center asset class, which typically ranges from around 4% to 5%.
Why is it lower than, say, a strip mall?
Data centers generally carry lower capitalization rates or cap rates than standard commercial real estate like malls or office buildings, largely because of the high barriers to entry and the mission-critical nature of the tenants.
That makes sense.
So DCRU's 4.94% is right in the mix, perhaps slightly on the lower, more conservative end.
The net asset value, the NAV per unit, which is the underlying book value of the properties, has moved in the exact opposite direction.
It has. It really has.
It has risen from a calculated US dollars 0.70 back in December 2023 all the way up to US dollars 0.79 in June 2026.
The step up in the net asset value was largely driven by massive fair value revaluation gains. Specifically, they recorded a $251.6 million gain in FY 2024 and then added another $22 million in FY 2025.
Wow.
The valuation increase was not driven by operational retention.
Right.
It wasn't because management magically collected vastly more rent from the tech companies and saved it in a corporate bank account. It is purely paper wealth.
Just a number on a spreadsheet.
Right. The underlying freehold assets are appraised higher again, largely due to the scarcity of the power constraints we discussed earlier, but the actual operational cash flow generated by those assets in the current period has slightly shrunk. And if the operational cash flow is shrinking while the asset values rise, we are forced to look at the expenses that are eating into those operating profits. Where is the money going?
In commercial real estate, especially at this scale, the single biggest, most volatile expense you always have to scrutinize is the debt.
Absolutely.
Let's lay out the raw mechanics of their debt from the first half 2026 results. The all-in cost of debt currently sits at 3.6%.
Okay.
The total debt outstanding is a massive $716 million. Now, structurally, there is some very positive news regarding how they've engineered this debt.
Yes, the structure is quite sound.
It is 100% unsecured, it is 100% unencumbered, and they have no refinancing requirements looming until December 2027. The weighted average debt maturity is 3.3 years.
We should probably break down why that structure is so important. Unsecured and unencumbered means that management hasn't had to pledge the actual physical data centers as collateral for specific individual mortgages.
Their aggregate leverage has climbed to 39.2%.
That is high.
It is. That is a significant jump of 520 basis points in just the last 18 months. Management themselves note that this is sitting near the very top of their internal target range.
Yeah.
And while they have that runway until 2027, the safety net regarding interest rates is definitely fraying. The percentage of their debt that is locked in at a fixed rate fell from 85% down to 70%.
That's a big drop.
And consequently, their interest coverage ratio, which measures how easily their earnings can pay their interest expenses, dropped from 3.6 times down to 3.2 times.
And all of these metrics, the leverage, the fixed rate drop, the coverage ratio, culminate in what is arguably the most crucial risk metric in this entire financial analysis.
The spread.
The spread. The aggregated property yield is 4.94%. The all-in cost of their debt is 3.6%. If you subtract the cost of the money from the yield of the buildings, you're left with a spread of just 1.34 percentage points.
1.34%. That is razor thin.
The analysis clearly notes that this 1.34% sits below the industry standard 2 percentage point comfort line.
Okay.
It is an incredibly tight margin between operating a profitable enterprise and simply breaking even on the cost of your financing. The financial results detail a very specific sensitivity analysis on this exact point. If the weighted average interest rate increases by a mere 100 basis points, just a 1% increase, their interest coverage ratio drops from the current 3.2 times down to an uncomfortable 2.5 times.
And the scary part is management doesn't control that rate. Who decides if that floating rate goes up?
Central banks. Because DCRU's debt is globally syndicated and spread across USD, EUR, and JPY to match their geographic footprint, they are directly at the mercy of the U.S. Federal Reserve, the European Central Bank, and the Bank of Japan.
They are globally exposed to macroeconomic monetary policy. DCRU currently trades at a price to NAV of 0.64x. When you look at the peer comparisons provided in the data, the contrast is glaring.
Very glaring.
You have Keppel DC REIT, which trades at a price to NAV of 1.33x. The market is actually paying a 33% premium for Keppel's assets.
Right, and their yield is 4.55%, lower because of that premium price.
Exactly. And then NTTC REIT trades at 1.05x, so a slight premium, with a 7.54% yield. Out of the major listed peers, DCRU has the absolute deepest discount by a wide margin.
We also have to benchmark that 7.19% distribution yield against risk-free alternatives to understand the risk premium investors are demanding.
How does it compare?
The data shows that DCRU's 7.19% yield maintains a 4.8 percentage point premium over the Singapore 10-year government securities, which are yielding around 2.43%.
Okay.
And it offers a 3.19 percentage point premium over the CPF special account, which has an ironclad interest rate floor of 4.00%. The financial documentation points us directly to their annual report for management's stated ambition.
Okay, what is it?
The CEO's strategic outline presents a very clear, aggressive target. They want to double the asset base and double the market capitalization over the next 3 to 5 years.
Double it in 3 to 5 years.
Yes. The underlying logic here is that by massively scaling up, they can lower the overall risk profile of the trust, increase diversification, and improve unit liquidity, which should ideally close that valuation gap.
And there is some serious heavy-hitting sponsor activity backing up this ambition.
Right.
Digital Realty, which is the global sponsor behind DCRU, recently executed a massive acquisition. They bought Blackstone's stake in 3 massive Northern Virginia data centers.
We were talking about a blended 64% interest in 288 megawatts of fully leased IT capacity at a staggering $7.8 billion gross value.
$7.8 billion. Now, to be clear, the data notes this is sponsor-level scale, meaning DCRU itself didn't buy these assets directly, but it feeds what is called the right of first refusal, or ROFR, pipeline.
Right.
Basically, when the sponsor, Digital Realty, is ready to drop down or sell those assets, DCRU legally gets the first chance to buy them.
Alongside that massive multi-billion-dollar pipeline potential, we also see management taking ownership activity at the ground level.
What do they do?
In the first half of 2026, DCRU used capital to buy back and cancel 7.98 million of their own units at an average price of 48.8 cents.
Oh, okay. A big buyback.
And previously, in FY 2025, they bought back 1.75 million units at 56.5 cents.
Okay.
If they attempted to debt finance a massive acquisition like that right now, they would instantly blow past their gearing limits.
Right.
They would likely trigger debt covenants with their existing lenders.
Right.
And their credit rating would be downgraded, making all their future debt vastly more expensive.
Exactly. So if the debt avenue is blocked because leverage is maxed out, the only other way a REIT can raise the billions of dollars needed to double in size is to issue new equity.
Yes.
They have to sell new shares to the public. But their share price is currently sitting at a 36% discount to its actual value.
Right.
If management issues millions of new shares right now at 50 cents to try and buy assets that are valued at full market price, it would be incredibly, devastatingly dilutive to the current shareholders.
It could be brutal.
You are selling ownership in your company for pennies on the dollar to buy assets at full price. It destroys shareholder value. So how on earth do they practically finance this ambition to double their asset base?
You have just perfectly articulated the ultimate agonizing dilemma of a distressed REIT.
It's just a massive paradox.
It is a vicious, frustrating feedback loop. Management correctly identifies that they need greater scale to lower their risk profile. A bigger, more geographically diverse portfolio with more tenants is fundamentally safer, which the market usually rewards with a higher valuation multiple.
Sure.
But right now, because they are perceived as too risky, driven by that thin debt spread and the negative DPU growth, the market is severely punishing their share price.
Yeah.
They desperately need the scale to fix their broken valuation. But the broken valuation prevents them from being able to afford the scale without destroying their existing shareholders.
They're completely trapped in a holding pattern. They are buying back tiny fractions of their own stock just to show the market they believe in the value, while a $7.8 billion pipeline of premium assets sits tantalizingly just out of reach because their currency, their unit price, is too weak to utilize.
Exactly. So the only way out of the trap is to wait for macroeconomic conditions to change.
Like what?
Specifically, for global interest rates to drop, which would widen their debt spread and naturally lift the unit price. Or they have to flawlessly execute on the operations of the buildings they already own to organically rebuild market trust.
Which means to see if they can survive long enough to pull off this expansion, we have to look inside the physical buildings themselves.
Right. Let's look at the operations. Because when you strip away the debt and the macro environment, the underlying operational metrics of these specific freehold properties are exceptionally strong.
Okay, give me some good news.
The portfolio occupancy sits at a very robust 97.3%.
That's practically full.
In commercial real estate, anything above 95% is generally considered essentially full, allowing for normal tenant turnover.
And the data shows they have incredible pricing power with the tenants they do have. The filings highlight 25% cash reversions in the first half of 2026.
Which is huge.
This means that when an old lease expires and a tenant signs a renewal, the new rental rate is 25% higher than the old rate.
Right.
That is massive pricing leverage. They even highlight a specific operational win. Their Linton Hall property was relet at a staggering plus 35% starting in December 2026.
This brings us right back to our opening discussion about the physical power constraints of the grid.
Yes.
Why does a landlord have the leverage to hike a tenant's rent by 35%?
Because they can't leave.
Because the switching costs for the tenant are astronomical. If a major tech company's lease is up, they can't just easily unplug thousands of mission-critical servers, put them on a truck, and move to a new building across the street.
Right, because as we established, there probably isn't a new building across the street with the necessary gigawatt power connection.
Exactly. The local grid can't support it. So the tech company is effectively captive. The landlord holds the structural leverage in that lease negotiation, hence the ability to drive 25% to 35% rent hikes.
That structural leverage is the very clear good news. But then we hit the core vulnerability in their business model.
The concentration risk.
The bad news is the concentration risk, yes. The data shows the tenant concentration level is 70.2% for their top 10 tenants. But this next statistic is the one that really makes you pause.
It's a big one.
Their single largest customer accounts for a staggering 30.3% of their annualized rent. One single company pays almost a third of the bills.
However, we have to balance that spreadsheet fear with the commercial reality of who these specific tenants are. The data points out that 80% of their total rent comes from investment-grade tenants.
Okay, so they are reliable.
The overall portfolio WALE is currently shortening down to 4.3 years.
Which means, on average, they have 4.3 years of locked-in, guaranteed rent before they have to sit down at the negotiating table again.
Exactly. But looking at averages can hide acute, specific dangers. The filings explicitly call out their Los Angeles property.
What's happening in LA?
It currently has an 85.6% occupancy rate, which is noticeably on the lower side compared to the 97% portfolio average. And it has a very short 1.9-year WALE.
Oh, wow. Less than 2 years.
This means within the next 24 months, a significant concentrated portion of the leases in that specific LA building are expiring and need to be renewed or replaced.
And they also note occupancy softness at another property located at 200 North Nash, which is currently sitting at 81.7% occupancy. So they clearly have some regional weak spots they need to aggressively patch up.
They do.
But there's another internal risk flagged here that goes right back to our discussion about the share price trading at a 36% discount and involves how the management team themselves are getting compensated.
Yes, the issue of fee dilution.
Right.
The data notes that 100% of the manager's fees for running the trust are currently paid in units rather than in cash. It makes it that much harder for the share price to recover to its true NAV.
And just to round out the localized risks, the filings mention one last regional issue, an unresolved data center tax exemption status looming in the state of Virginia.
Right. Virginia is a huge hub for this.
It is. Now, while they don't provide the exact dollar figure impact in this presentation, anything involving unresolved local taxes in a major global data center hub like Northern Virginia is a dark storm cloud worth watching. Local municipalities are realizing how much power these centers use, and tax battles are becoming more common.
Right now, if you look at the analyst reports, the financial markets are entirely obsessed, and rightfully so based on the math, with DCRU's thin debt spreads, their shortening lease expiries in Los Angeles, and the ongoing dilution from manager fees.
Right, the spreadsheet is what dictates that 36% discount.
Exactly. But if you step back from the quarterly filings and look at the exponential global growth of artificial intelligence, if you truly internalize the fact that local physical power grids, not available land, and not even available capital are the true immovable bottleneck for building the new data centers required to run this technology, we have to ask a much bigger question.
That's the question.
Is the broader market vastly underestimating the long-term geopolitical and technological leverage of simply holding the physical keys to these existing freehold fortresses?
Oh, that's interesting.
Right, yes. Having a single tenant account for 30% of your revenue seems terrifying on a spreadsheet today. But in a future where AI requires gigawatts of tightly constrained power that utilities simply cannot provide quickly enough, will the financial leverage eventually flip entirely? Will the landlords, the people who actually own the power connections, eventually dictate all the terms to the tech giants, simply because the tech giants have absolutely nowhere else to plug in their servers?
No, that is a thought that fundamentally changes how you look at this entire sector.
It really does.
The cloud might be digital, but at the end of the day, the person who owns the physical power outlet gets the final say. We highly encourage you to keep digging into the sources we discussed, check out the full detailed deck and the first half 2026 financial results for yourself, and see where you land on the great divide between physical constraints and digital growth. Thanks for joining us for this deep dive.